Dividend growth stocks are a great way to grow your wealth over time, and they're even better when they come at bargain prices. So in today's video, we're going to go over 5 dividend growth stocks currently trading near their 52-week lows. But make sure you watch until the end because I have a couple bonus stocks for you that you don't want to miss. These are all stocks that are profitable, have a dividend yield of 3% or more, they have 10% or higher dividend growth rates over the past 3, 5, and 10 years, and they've been beaten up recently and sit within 10% of their 52-week lows. Okay, let's get to it. Our first company is Haverty Furniture Company, ticker HVT. As their name suggests, Haverty is a furniture company that owns the universally known Sealy, Serta, Stearns & Foster, and Tempur-Pedic brands. They also sell all types of home and office furniture. Sounds boring, and they are a boring company. Revenue and cash flow are stagnant, earnings are a little better but still not great, and their price is down 24% over the past year, due primarily to a ton of demand being pulled forward during the pandemic as millions of households refurnish their homes. The pulling forward of this demand is now catching up with them. The recent pullback has created a value investor and dividend investor's dream setup. They're trading at an 11 forward PE, not even one-time sales, and a 7% free cash flow yield. This stock is a bargain based off its history of cash flows and earnings. They have no long-term debt, but they do carry a significant amount of capital leases due to their retail presence. And best of all, they pay a 5.1 dividend yield with only a 43% payout ratio. And their dividend has been growing by 12% over the past 5 years. In other words, you can collect the same yield that you can get on treasuries as a baseline return with the possibility of substantial price appreciation. And if it couldn't get any better, they've been regularly paying special dividends every fourth quarter for the past several years. Even though these are expected to be smaller and possibly even eliminated while they work through this contraction, management has clearly demonstrated that its goal is to return as much as possible to shareholders in the form of regular dividends, special dividends, and share buybacks. Morningstar doesn't cover Haverty, and CFRA rates them as a hold, which implies that they're trading near where they consider to be a fair value. But if we compare it to the $32 that it was trading at 1 year ago, we could be in for a 28% upside in this stock. Every investment comes with risks, and for Haverty, they are the concern of a potential slowdown in consumer spending as a result of inflation and higher interest rates, along with concerns specific to the industry as households refurnish their homes during the pandemic and probably will not do so again for several years. Then there is the expectation of reduced special dividends and share buybacks over the short term because of this reduction in demand for household furnishings. And finally, the low daily volume creates some liquidity concerns for investors. I typically want at least 1 million shares to trade daily, but Haverty stock averages less than 150 grand. Our second stock is FMC Corp, ticker FMC. FMC is an agricultural company that provides crop protection and pest management products such as insecticides, herbicides, and fungicides. Surprisingly, FMC is Morningstar's top agricultural pick, with a Morningstar fair value estimate of $110 per share and CFRA's fair value calculation coming in at 99. That implies anywhere from a 74 to 93% return potential, or if we compare it to the $95 it was trading at 1 short year ago, we're looking at 67% upside in this stock. It's a reasonably profitable company with a baseline net profit margin of 10 to 15%. Don't be fooled by the official 28% net margin number in 2023. They benefited from a one-time $1.1 million tax credit. If it wasn't for that large credit, their margin would have been a terrible 4.5%. After a 16% pullback in 2024 and a 42% drop over the past year, they're currently trading at what seems to be a pretty reasonable valuation. They trade at a 15 forward PE, 2 times both sales and book value, and a 2.5% free cash flow yield. They pay a 4% dividend yield with only a 24% payout, so the dividend looks pretty safe, and this dividend has been growing at a 16% rate over the past 10 years. On top of that, they buy back about 1% of shares outstanding each year. All this sets up a similar situation as our first stock, where not only will you be paid to hold the stock, there is the possibility of substantial price appreciation if they can get back to where they were trading just 1 year ago. Let's move on to the risks. All of the risks are associated with the industry they compete in. They're a small player in a competitive market with a couple large players, and these types of companies make money by spending a bunch on research and development with the hopes that they can develop an effective product that they can then patent and sell for 20, 25 years without competition from generics. The problem is that there are no guarantees that the heavy investment in R&D bears any fruit, and even if the R&D spending does pay off with a big winner, patents will eventually expire. Needless to say that as patents expire, it puts pressure on their margins, puts pressure on the company to develop the next product to offset that decline in revenue. In fact, their top 2 patented formulas are set to expire in 2026, which has been a major factor in this large dip in price. There are also regulatory risks, which are primarily legal as a result of the nasty chemicals they produce. And finally, they're impacted by the well-being of their customers, the farmers. A drop in farmer incomes, declines in crop prices, and severe weather events can materially impact their profitability. If you're enjoying this video and feel like you're getting some value out of this content, I'd appreciate it if you took a second to hit that like and subscribe button. It's an easy and free way you can support this channel and help me continue to bring this type of analysis. Okay, let's get back to padding our pockets with dividends. Our third stock is Papa John's, ticker PZZA. Papa John's is a company that needs no introduction. The stock has been clobbered since late 2021, going from $130 per share down to $43 per share that it currently trades at, due to the ousting of the founder as he used racist slurs on a conference call, a loss of market share to Domino's and Pizza Hut, and unhappy franchisees. They're down 43% year to date after the biggest revenue miss in 5 years. But Morningstar seems to think this is a good time to buy. Morningstar states that with the company navigating the public relations fallout, we believe Papa John's brand has fully recovered and view embittered franchisees' willingness to reinvest in unit development as the strongest attestation that the brand recovery has more or less come to fruition. If you're a patient investor that is interested in taking a shot on some significant price appreciation in addition to the 4.3% yield that they offer, then now could be a good time to buy. I was surprised by the level of shareholder distributions from Papa John's. Not only is the current dividend sitting at a healthy 4.3%, it's been growing at a very nice 14 to 15% over the past 3, 5, and 10 years. And that's not it. They're also buying back 3% of their shares outstanding every year, for a total shareholder distribution around 7%. That's about as good as it gets from a publicly traded company. They're trading at a 23 forward PE, which isn't that cheap, but one-time sales and a 5.6% free cash flow yield suggest that it's a fairly decent value, especially if they can get back to where they were 5 years ago. Morningstar's fair value estimate comes in at $69 per share, while CFRA estimates that each share is worth $52, implying that the pizza maker is undervalued by anywhere from 21 to 60%. Or, if we compare it to the $77 it was trading at 1 year ago, we could be looking at a 79% upside in this stock. Papa John's comes with several risks, however. Their dividend comes with a 79% payout ratio, which I consider quite high and at increased risk of a dividend cut. Even though they don't have much debt in total dollar terms, as a percentage of the capital, it's not looking good at 224%. They've been taking on significant amount of debt to pay those sky-high dividends and share buybacks, which makes me question the sustainability of those shareholder returns. Additionally, they're losing market share to Domino's and Pizza Hut. There are also concerns about a slowing economy and consumer spending. Wage inflation has been a headwind on their margins and could prove even more detrimental should wage inflation persist. And finally, being in the fast food industry, there is an insane level of competition, so they don't have much of a competitive advantage. Our fourth stock is NetEase, ticker NTES. NetEase is a Chinese online gaming company first and foremost, but they also offer streaming music and educational apps. They've traded down 13% over the past year due primarily to the unpredictable nature of the Chinese gaming regulators and the economic contraction that China is going through, which resulted in a slight revenue miss. It currently sits about 10% higher than their 52-week low of $81, and with a Morningstar fair value estimate of $159 per share and CFRA's 12-month price target of $130 per share, implies anywhere from a 40 to 71% return potential. Or if we compare it to the $103 it was trading at 1 short year ago, we're looking at 11% upside in this stock. NetEase is the most interesting company on this list because it's actually growing at a solid rate, unlike the other stocks on this list. They're highly profitable, and even though their margins have compressed over the past decade, they've been expanding over the past 5 years. Their debt is minuscule. They offer a 2.8% yield, which is quite good for a large cap growth company. You can ignore this 290% payout ratio. I'm not sure how that was calculated. Everywhere else I looked, they have a payout ratio at 32%, not 290%. They also traded at a very compelling valuation with a 12 PE, 1 times sales, 3 times book, and a staggering 54% free cash flow yield. That's not a typo. There is one big ding on this stock though. Their dividend is highly volatile. It's not consistent like most other companies. Although it has been growing at an insane 15 to 20% rate over the past 3, 5, and 10 years. If history is any indication, they will not hesitate 1 second to cut the dividend if they want to. The primary risk with NetEase is that they're headquartered in China. According to Morningstar, the unpredictable nature of China's regulatory environment was demonstrated from August 2021 to April 2022 when the issuance of gaming licenses came to a halt. This pause was a response to new limitations on gaming hours for kids 18 and under and a more stringent examination of game content. The potential for further regulatory intervention of this kind poses a material threat to NetEase's financial performance. Furthermore, their gaming segment accounts for 70% of revenue and more than 100% of their profitability. Their other segments are losing money on a net basis. Also, the online gaming industry is fiercely competitive and is characterized by unpredictable user interests. Lastly, they spend about 15% of revenue on R&D, which may not lead to successful games. Our fifth and final stock that met my criteria is Ethan Allen Interiors, ticker ETD. I'm guessing that you're all aware of this furniture and interior decoration company, especially if you live in America. They were up and coming back in the early 2000s, but have since stalled out. Their revenue and cash flow have gone nowhere for 20 years, but after a 9% pullback in 2024, they're offering a fantastic dividend yield at a compelling price. A 5.4% dividend yield with only a 52% payout ratio is music to any dividend investor's ears. Furthermore, they're growing their dividend 10 to 15% per year, and they've paid out 6 special dividends in the past 10 years. At 10 times earnings, 1 time sales, and a very nice 9% free cash flow yield, this stock would have my attention if I were a dividend investor. That's not all. They're buying about 1% of shares outstanding back each year as well. Morningstar doesn't cover the stock, while CFRA has a hold rating on them, implying that they think ETD is fairly valued. But if they can get back to where they started this year at, an investor can take advantage of a 10% price appreciation on top of that stellar dividend yield. The risks involved with an investment into ETD include the fact that this company really isn't growing anymore and hasn't for quite a while, and correspondingly their stock price has been stagnant for the past 30 years as well. Declines in the overall economy, with consumer spending, preferences, and confidence being the large factors driving their business. Unemployment, inflation, and housing market activity also have a large impact on their operations and profitability. They only trade about 200,000 shares per day, so there are some liquidity concerns. And finally, they do business in a highly competitive market, with price, brand, and product differentiation being the largest competitive factors. Well, that wraps up the 5 dividend growth stocks trading at significant discounts, but before we close this video out, I had a couple honorable mentions for you. These are both very well-known global companies that didn't quite meet my criteria, but given that they're both trading near 52-week lows and are huge with dividend growth investors, I have to at least mention their names. First up is McDonald's, ticker MCD. They're highly profitable, and they're sitting at a 52-week low. The 2 criteria they didn't meet were the 3% dividend yield. They currently pay a 2.6% yield, so they're close. And they fall short of the 10% dividend growth criteria, with only an 8% growth rate in their dividend over the past 5 and 10 years. However, they have picked it up over the past couple years, and they're buying back a decent amount of their stock, which is also a form of a shareholder distribution. You've got to consider the totality of shareholder distributions rather than just the dividend side. Morningstar values it at $300 per share. CFRA puts a $280 12-month price target on it, and if we compare it to where it started the year, there is 13 to 18% upside potential in this stock. The risks with Mickey D's are concerns about weakness in consumer spending. There's a short-term concern that you shouldn't even pay attention to if you're a long-term investor. Then there are concerns about longer-term market share losses. And for me, their debt is out of control at $52 billion. Their debt is so out of control that they have negative equity. If interest rates stay higher for longer, their servicing costs will increase significantly and start eating away at their profits. Next, we have UPS, ticker UPS. Like Mickey D's, UPS needs no introduction, but they do need a catalyst for their stock price. They're down 10% year to date and 22% over the past year. They pay a nice 4.6% dividend yield, but they just missed meeting all my criteria as their 10-year dividend growth rate fell just under my 10% threshold. As would be expected, the growth has really slowed the past couple of years after that monster 49% increase in 2022. Let's not forget about the share repurchases of about 1% of shares outstanding each year, and they're trading at a fairly reasonable price with an 18 PE, one-time sales, and a 4.5% free cash flow yield. The problem with a stock like UPS is that it has never been a compounder and never will be. Its revenue growth is low, its earnings and free cash flow have been stagnant for the past 25 years, and its stock price has barely doubled over the past 25 years. For perspective, the average return of the S&P 500 over the past 100 years has been about 8% per year. At that rate, you double your money every 9 years. UPS, on the other hand, has taken 25 years to double. All UPS is really giving you is a nice growing dividend, so if that's what you're looking for, then this may not be a bad pick. Just be aware that they post a 94% payout ratio, so any slowdown in the economy or business, and that dividend is in serious jeopardy. Additionally, UPS is heavily dependent on the U.S. economy and Amazon in particular. We all know how cutthroat Amazon is. Their partnership is working for both firms right now, but if Amazon can find a better or cheaper way to ship their packages, they will not hesitate to stick it to UPS. Morningstar values it at $158 per share. CFRA puts a $149 12-month price target on it. And if we compare it to where it was one short year ago, there is 5 to 29% upside potential in this stock. And finally, I wouldn't be doing my job if I didn't say anything about a handful of small and mid-sized banks that did meet my criteria. I don't know a thing about these companies other than they met my criteria. And there you have it, a handful of dividend growth stocks currently trading at bargain basement prices. Let me know your thoughts in the comments below. Are there any dividend growth stocks that you like that I didn't mention in this video? If so, leave a comment. And make sure to like and subscribe so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. We'll see you in the next video.